Okay. All right, everyone. Let's say, welcome to our December webinar. Can't believe it's December already, and what a year we've had. So I'm going to spend a little bit of time today talking about what we just went through and what we're set up for 2021. There's some big themes that we're going to cover today and implications about the data and how we're working with clients. I'm going to spend. We got a lot of regional and local data that we can dive into in the second half of the webinar. We'll look at, I've got a bunch of reports up and we can dive into some of the local markets. I'd like to encourage you today to have the little chat box open. The chat box we have a couple from the Altos team in the chat. So if I mention things like a link or things that'll be in the chat, you can click on those right there. You can also drop questions in, and so the team will try to answer questions on the fly. So have that little chat window up. That'll be good. We're also going to do a poll today. So I'm going to test out a poll and see if we can get some interesting insights from our crowd. And in general, I try to aim for about 45, 50 minutes. We'll see exactly how much time we spend on each of the local data and see how far it goes. So lots of people from all over the country in here. And, we're going to dive into it. So welcome. Let's get going. Before we actually hit the data, if you are not yet aware, we've recently published this ebook, How to Use Market Data to Build Your Real Estate Business. So if you're on this call, you are probably interested in using data in your real estate business. If you have not yet already grabbed this ebook, you should do so now. So the link right here on the screen, it's also in the chat. You can just click on it and go grab that download. It's really extensive. It talks about the data that I refer to, that I use all the time in these videos and with clients. It talks about how to use the reports and where to point people. I will today, you'll notice some of the techniques I use with the data that we explain in that ebook. So if you're a professional in the real estate world and you think you might have to communicate with clients this year, maybe grab that ebook. So head on over that right now. As I mentioned, if you've got a question, drop it into the chat. We've got folks from the Altos team in the chat, so they can answer questions on the fly and hopefully get and provide links, etc. So use the chat box as we go forward. Okay, big trends. This is our agenda for today and the big trends that we are looking at in 2021. If you are familiar with Altos research, you'll know that Altos focuses on the active market. We track every week every home for sale in the country. And it turns out that especially in a crazy market like today, that active market view is more important than ever. So I'm going to spend a little bit of time on what we mean by that and why that's critical. We all know by now, if you're on this call, you'll know that we are in this crazy low inventory and crazy skyrocketing prices market. It's pretty much true for the whole country, with a few tiny little exceptions. And there are implications for our business for working with buyers and sellers during 2021. And so along the way, I will try to mention what this really means, what we're how we work and how we communicate with clients. The big overhang for the year are these distressed mortgages. There are people in forbearance, hit a lot of personal economic crisis in this whole pandemic time. And so it is smart for us to keep our eyes on what's happening with those. There are real signals. There's real signal in the data. We know what's happening. And so we have some good insights on how to prepare for 2021. The local data, the Zoom towns, we're going to spend a little bit of time on the Zoom towns. That's one of the big trends, of course, during the year. People got to work remote. They moved to remote places, driving up prices in some like resort towns or places where they haven't been able to spend much time before. So we've got some local data on the Zoom towns and other parts of the country. And then I will also like to keep in mind the risks that we have facing us for the year. And really these risks, we have this ultra low interest rate environment, which has been spurring demand. So if rates rise, we face risks. We also have a risk if we are in this spiking pandemic, lockdowns are happening more. We know that like we have to pull back from businesses. And there are impacts if we fail on stimulus in the new year. That could have a significant negative economic impact. And that could spill over into housing. So these are the risks that we're facing. So these are the trends this is what 2021 looks like. And so we will march forward into the data. Possibly the most important factor that we have to deal with this year is communicating with buyers and sellers about what's actually happening in the market. If you'd followed along with the Altos data, these webinars each month this year, you'll know, of course, the market started skyrocketing in April. We've had massive gains for 8 months in prices. Demand has been off the charts. But you'll still see headlines and worry about things like foreclosures. These are headlines from like literally this week. Foreclosure wave and 6 million Americans at risk, millions of homeowners at risk. So these headlines are there. And every time, it's funny, every time I share video work that we do or publish things that we do, the social comments are like, what about the foreclosures? Or just wait until all the foreclosures happen. So there's still a lot of conflicting opinions. And there are a lot of models, a lot of forecasting models from different players in the industry where, for example, there's this chart here from Goldman Sachs. So Goldman Sachs published their housing market forecast this week. And down here at the bottom, you can see for their estimate for 2020 home prices, 4.2% price increase. 4.2% price increase. They're using the Case-Shiller index. This Case-Shiller index that came out in September that used June, July, and August data. It's 6 months, 8 months old. And so they see 4.2% gains for the year. If you're looking at the Altos data, you'll know we're at 10% gains. So we're in this world. Let's see. Oh, we can't see the bottom of the screen. Oh, man. I have to adjust my slides in the next time around. So the thing that we're seeing is the important key here is that when we look at the active market, we know that the demand right now is high. We know that the pricing increases are happening. We know that the inventory is low. And we can see that in the ask prices on the market. We can see it in the changes in those prices, all these elements. The traditional approach is to use the sold data that happened a few months ago. And when we're in this rapidly changing market, we know that that lagging data is going to be difficult to communicate with clients. So we're going to use the Altos data, I'm going to hand them the report, and we're going to use that right now. Here's what I'm interested in. we're going to run a poll today. The poll I'm interested in is like we know that there are lots of people in the country who have experienced economic crisis, right? Maybe they went from 2 incomes in the household down to 1. We know that there's a lot of small businesses that have had to shut down, restaurants, and like those that have been really impacted, retail, by the pandemic. What I'm interested in, what we know is that, so that's what these headlines are based on. These headlines are based on, there's a bunch of people who are in mortgage forbearance who are not paying their mortgage this year. Turns out that they're not actually in risk of foreclosure because we have record levels of home equity. Home prices are climbing. So even if you weren't able to make your mortgage payment this year, your home value climbed by 10% on average in this country. So your equity gained a ton. So in the spring, when we have to move out of the forbearance window, when these people have to start paying their mortgage again, they are unlikely to go into foreclosure because they have a lot of equity and because there's so much demand, they can sell their house really quickly. So even if they are unable to make their mortgage payment, there's way better options than going into foreclosure. So the poll that I'm interested in knowing from you is, have you talked to any potential sellers who are worried about their ability to make payments due to the pandemic? This means maybe they're not ready to sell, but they're worried. So what we want to know is where that conversation is. For me, this is really interesting because you, as the frontline realtors and professionals in this space, may be seeing things before we actually list the properties and before we get it into the data. So you're the earliest leading indicator of the risk here. And people are voting, and this is terrific. We're getting a bunch in, and it's the results are starting to mirror my hypothesis of what we would expect. Okay, I'll give one more second to see if anybody else has some votes. So have you talked to anyone, like just in casual conversation, or people who are like worried? And I think it's okay. We're gonna. This is great. We got our votes coming in. I'm gonna end the poll here in a second, and we'll share the results here. Okay. So this is really fascinating. This is sort of what I was expecting. 80-20. 20% of us have had these conversations. And some of these, as I see a comment in the chat, which says, yes, I've had the conversation, but actually very few. And the reason it seems to be, to me, is that we've had these very few conversations because we're actually not at risk of having very many people go into foreclosure. The people know that they've got really cheap mortgages, they've got a really good deal, they've got low holding costs, they got a lot of equity. They are going to work very hard to keep that property and keep that deal. Selling the property would be next. Take your equity cash if it looks like I'm not going to be able to ever make my mortgage payment again. Or if I look like I'm not going to be able to do a loan modification to work out and get in a better place. Then the last resort would be a handful of people who are not, who are underwater for whatever reason, or they're in a place where they can't sell the house, and now they can't even do a short sale. They have to walk away from it and go into foreclosure. The properties that we do see obviously going into foreclosure, some commercial things where the rent has evaporated. Maybe some investment properties that were highly leveraged. Those are where we're seeing those things happening, but it's really fascinating. And I'm going to keep asking this poll each month to see, for example, if we get close to next next spring. Right now, there is the foreclosure moratorium has been extended through January 31. The talk in the industry is that it's likely to be extended through the end of June at the least. So we're likely not going to have any foreclosure activity at all until the end of June. All the legislation is very much in favor of the sellers, of homeowners. So keeping people in their homes, and that's unlikely to change. Super interesting. Okay. Thank you for your input on that. So why are we looking, why do we need to look at the active market? If we were to just look at those headlines or the traditional approach, we would think that we could be potentially at risk of some of these distressed sales. But what we know is that the list price now, the active market now, tells us where these properties are going to sell in the future. We know that a house on the market now gets an offer in January, it closes in February. We know now that where the January, February, March data, sold data is going to show up. The other reason that we use this approach is that when we're talking with buyers and sellers, we can say, this is what you see when you walk into the market today. This is what your competition looks like. This is what your urgency looks like. Do you have to make an offer quickly? In this currently high demand market, where especially with all the mortgage, all the refinances, all these things going on, some of the closings are taking longer to happen. So now if it's 40 to 50 days between offer and close, now that sales data gets even more and more stale before you can communicate it to your clients. So that's why we're focusing on the active data. And then beyond that is, it's not just the sold price. It's not just these 6 houses sold last month. It's these 40 are on the market. These only 2 have taken a price cut. And in fact, 4 have increased their prices. That's incredibly bullish for the market. And that's what we're looking for in the active data. We're looking for, how long are these been on the market? How long is that changing? What's our market action index at? Supply versus demand. All of these are active market data. And it's why we want to focus on that during this year. Your clients are going to need that more than ever to understand, do I got to make an offer now? Do I got to take action? This is where we're going. Okay, so that's our time with the active data. Let's actually dive into the data. Median home price in the US this week is just over $347,000. So we're ticking down week over week, but barely backed off from our midsummer peak. This is the dark red line on the chart here. You can see the year over year gain, the little bubbles is where each year we are. And of course, when we go into the holidays, the good inventory typically is pulled off the market. It's waiting till January before it starts to come back on. So prices are seasonally at their lowest point. One of the things you're going to see is a lot of the numbers, for example, the government numbers or the NAR numbers use seasonally adjusted. They use seasonally adjusted sales rates. They use seasonally adjusted pricing so that you can, because we know that the market pulls back in the fall, for example. When the market doesn't pull back, those seasonally adjusted numbers are going to look significantly higher than they would. So the market's been strong, and the market has been especially strong for a fourth quarter. So keep that in mind when those headlines come out. They're going to be very bullish for the next several months. The new listings, the blue line on this chart. So this is, remember, the cohort of properties that come to market newly each week. What this allows us to check, this price of new listings, is the earliest leading indicator for what you, the real estate agent, sees, what the client sees. And what happens is, if you're talking to a client now, you're in your listing presentation, you're settling on the listing price. You know how many people overbid on that house down the street. You know where the new ones get listed, and you know that there's no competition out there, and you know that you've got a lot of buyers circling around. With that information, you and your colleagues price the new listings a little bit higher each week. And so this new listings takes the wisdom of the crowds, it's called, is the first place we get to see it. These new listings, of course, over Thanksgiving week, like last week, and coming up to Christmas, like who lists their property over Christmas? Well, some things get out. They've been in the works for a while and they sneak out in there. But in general, they're going to be, you're not listing in for strength on Thanksgiving week. And so you're going to see that new listings price tick back. We've got a few more weeks of ticking back, and you can see the little red dots here. This is the year over year, what it looks like. The bottom, we're going to have 2 weeks in January of our new listings, and then what we're going to do is we'll have our January webinar. We'll see where we hit our new listings are. Then by the second and third week of January, we'll be able to watch this steep price increase as all the first wave of the first quarter new listings hit the market, and it'll give us a really good signal on how 2021 is going to end up. So right now we're 10% higher than we have been year over year. If you see things that are, and this is nationally, single family homes, if you see things, you see headlines that say like the Goldman Sachs number that's at 4.2%. The Case-Shiller number is catching up. It's lagging by several months, so it says about, I think, 7.9, 8%. If you look at this Altos data from the end of June, you will see that 4.2% gain. You'll see that 4 to 5% gain. So what some of the industry is seeing now, the headline is seeing now, is data from June. So that's why we want to keep our eyes going on that. And one of the easiest ways is stay on these webinars each month. Okay, let's get moving. Inventory. We are below 500,000 properties, 500,000 single family homes for sale in the whole country for everyone right now. 480,000. And of course, each week we've now got the rest of December and Christmas and New Year's. So we're going to be pretty close to 400,000 homes starting the year. It's nuts. It's 42% lower than last year. It'll be really fascinating to see where we start. But what this tells us is that no matter what happens with rates, with recession, we are way, way low. And so no matter what happens, the supply is going to be low. Demand, even if demand falls back, it's still demand in the face of ultra tight inventory. So that's a factor. It's going to happen during the year. We can see this. Our new listings rate is there's not like so this is the quantity of new listings each week coming to market. The dark red line is this year. The other lines are previous 4 years. And you can see that there's no sign of extra inventory coming to market. We're right in line. It's super low. We're not going to budge off of this 400, 500,000. We're going to get a few more in the market in January, but it's going to be ultra tight all year. So implications for communicating with clients. Think about this. There are 3 questions that the real estate consumer has. And you may have heard me talk before, and I like to point this out. What's for sale? How much is my house worth? And how's the market? We're of course talking how's the market here. What's for sale is why we have IDX searches. It's why Zillow gets all the consumer traffic. And answering that question, like what's for sale? One way we reach our consumer, reach our database, reach our buyer and seller clients is with listing alerts, listing alert emails. Hey, new house listed in your price range. These are the listings this week. But what happens to your listing alert emails when there are no listings? What happens is you don't send emails to your clients. You end up not reaching. I tell you a story. I bought a house in the mountains, ski house 5 years ago, and I get a listing alert email from my agent, and I still get it 5 years later, except that there are no homes for sale in my price range. They're gone. So I went from getting listing alerts every week to none. And now I never hear from my agent again. So how do you change that? One of the ways you change that is you shift from relying on listing alerts in a low inventory market. Listing alerts aren't going to cut it. The other problem with listing alerts is that every agent has it. But you can switch to your market reports, putting your market data in their inbox, because now what's interesting is you can show, hey, prices on the whole are climbing. You can see how low inventory is. You have the opportunity, for example, for my agent could say, well, if you were thinking of selling, now the inventory is super tight, they're going quick, your prices are way up, it's a good time to sell. So now you use the market data instead of a listing alert, instead of relying on these listing alerts to reach your clients. Something to think about in your work this year. That's why we do what we do. Big impact, big implications though of having tight inventory. On to days on market. You can see here, again, the dark red line is 2020. The other are the previous few years. You can see the normal arc as we go into the fourth quarter. In general, the stuff that's on the market still is sitting around longer. The best stuff and the hottest part of the transactions usually peak June 30th, and then we start cooling off for the fall, and then it resets in January as new inventory comes on. This was totally out of whack this year. And you can see that it was really not until late October that our market ended like it normally would on June 30th. So each week now we are ratcheting up. We're getting into a more normal range, and that's actually kind of healthy, right? And stuff gets listed, stuff gets purchased. This is average total days on market. And we get some questions from time to time, especially in crazy hot markets, from agents who ask us why our days on market is higher than their expectations. And what Altos does is we track total days on market. That includes properties that were relisted, taken off the market, didn't sell, pulled and relisted back in. So therefore what ends up happening is you get properties who, they've been off the market for 2 years, and Altos will track that as 2 years, where the MLS might say, hey, it's been on for 20 days. And now it finally goes this summer, right? So we had a lot of that this summer where these houses that were kind of junky or whatever, they sat around for a long time. They maybe were overpriced. And all of a sudden they're not overpriced anymore. Now, so you'll see that in the Altos data that in general, there will be some of those that keep that average days on market higher than where all your transactions are happening. You're like, oh, these are selling in 2 days, but there is some stuff that keeps it higher. So then the question is, what do you do about that? The thing I like to do is guide your clients into the market segments. This is what Altos does in every zip code in the country. And this is the national data we're looking at here. There are 4 price range segments. The high end of the market may be behaving very differently from the low end. And in this segments table that you get in the Altos reports, you'll see that exactly, the price range of the high end in the US about $1 million, but the low end stuff is 130K. And if we look at the DOM per market segment, you'll see exactly where the demand is. 89 days, this is that $250,000, $300,000 range. And you can see it's significantly lower. And when we get up into the $1 million range, like all of a sudden things stick around a lot longer. Every market in the country has this dynamic, and I'll show you some of that when we switch over and dive into the local data. Okay, before we dive into local data, I've got a few more things that we like to keep our eye on to understand the leading indicators for pricing in the first quarter. Percentage of homes on the market that have taken price reductions. Normally about a third, 35%, you can see this band from upper 20s to upper 30s is a normal market for the whole country, the country as a whole. We list new properties, we list in January and February. If they stick around through April, May, June, now it's a little, we start cutting the prices. And so the price decreases, the price cuts happen in that second quarter. They peak over the summer. And then in the fall, now there's less stuff happening. There's less, there's less action. There's less desire to cut prices. For example, to move it. We're just going to let it sit and then we're going to work on it again in the spring. So price reductions starts falling and then it'll hit its lowest in March before it starts that second quarter climb. And you can see in this year, there's a little bit of that March climb. We thought it tried to be a normal market before the pandemic hit. And then bam, our demand kicked up, our inventory cratered, and so we have had price reductions lower all year long. What this means is about 35% of people list their homes overpriced. Sometimes that's strategic, like we want to take a price cut before we sell it. Sometimes it's accidental or like a crazy seller who wants too much, whatever the reason is. About 35% do that, and then they take their cut before they sell. In this case, what we find now is 35% thought they overpriced, but only 26% have needed to take a price cut. That's because demand has been off the charts. And what that means is houses on the market now, if they take a price cut, that means the demand's a little weaker. That means the price that it's going to sell at in January or February is going to be lower. If we don't have to take those price cuts, the price they're going to sell eventually is going to be higher. So we know that right now the demand is in the market and the price cuts remain ultra low. They're going to keep falling now through February as the fresh new inventory comes on. And then we'll probably have more normal, a resumption of a more normal market in the second quarter of 2021. When we look on the other side of that, price increases. This is super interesting. So price increases happen generally for two reasons. One is it's flips. So we buy, we do maybe a little remodel and we put it back on the market. They also sometimes happen in a strategic manner in a hot market. So we're going to withdraw this house. We're going to put it at a higher price in a new demand range. And we're going to wait a few weeks as the market's heating up. And all of a sudden it comes back on the market at a higher price and then it moves. We are typically, you can see a little bit of the seasonal pattern here. The little triangle is the year over year, normally about 3%. In this 2018 time, price increases fell as mortgage interest rates climbed. All 2018, from beginning of March through the end of the year, interest rates were climbing. And what this shows is that as rates are climbing, demand was backing off. As demand is backing off, flippers, investors, and the strategic moves we know that that's less and less likely to pay off. If demand's backing off, I'm not bringing it back on at a higher price. So you can see price reductions, like fewer price increases as the year goes on. Through 2019, rates fell like a rock, and we started 2020 with ultra low rates. And so now things that were on in December come back on in that first quarter in higher prices. And we saw that spike at the beginning of 2020. Here's our initial part of the pandemic, is this big dip. And now we are in this ultra high demand space, where, for the whole country as a whole, 5.3% of the listings have had price increases in the last 90 days. This also may be the iBuyers, people going in, making an offer, and the big institutions like Zillow or Opendoor or some of the big hedge funds making offers and then relisting the property at a higher price. So you can see that taking place. And so we are significantly strong demand. And what that tells us, we know the demand's there now. As I pointed out, like, this is the leading indicator for prices, where the sales are going to close in January, February, March. You can already see it. Finally, we're going to dive into the Market Action Index. The Market Action Index is a proprietary Altos research number that looks at supply versus demand. So if we're in a big supply market, but there's a lot of demand, that Market Action Index will be higher. But as inventory falls and demand stays high, that Market Action Index, like a speedometer, stays super high. You can see this normal price range. We've been in seller's market conditions. It's above 30 is a seller's market condition. We've been in seller's market conditions for years, as rates have been generally low. Inventory has been crazy tight for the better part of the decade. This year, though, things went nuts. This bright red is the pandemic lockdown. And then in April, once things started to recover, we quickly climbed back up. We never even got to buyer's conditions. So this means that, there were people on the sidelines waiting, like, oh, when the bargains come, I'm swooping in. But we never even got there. People swooped in before then. So we're in this super hot, essentially record hot market. Still there. We've got holiday fluctuations. We're going to start the year in super hot market. It's also an indicator that when we do our seasonal comparison, the seasonally adjusted number, the headlines are going to be off the charts bullish for several months. They're going to be like, fourth quarter, December numbers, ultra high, like more things are selling in November and December than they normally would. So that is where you get your seasonal adjustment. So we can see that attention already. Okay. I've mentioned this last month and it bears repeating. We have two major drivers for demand, probably three if we think about the pandemic. But the first driver for demand is the millennials are now reaching their peak earning age and peak home buying age, their peak form the house, get married, have kids age. Because there are more millennials in that range than there have been of any other population, more than the baby boomers. So this wave of millennials is buying now. They're going to buy for the next decade. And so that demand is going to stay elevated for a long time. Now you couple that millennial demographic demand with our ultra low interest rates, and that makes for what we've got right now, like the crazy demand we have right now. If rates rise, that will very clearly put a damper on demand, but it won't change the demographics of the millennials. So that's something to keep in mind, that the long-term trend, the fact that we have so many millennials there driving demand, is an important part of our mix. When we look at then all the pieces and the risks, we've said very clearly it is unlikely that we're going to see a wave of foreclosures in 2021. Really, to get a foreclosure, to go into foreclosure means you have to be able to not make the payment, realize you're never going to be able to make that payment, and also be either upside down on that house and not able to sell the house. So there are people who are distressed and who may be in a fearful place where they cannot make their mortgage payments in the future. Like they went from 2-income household to 1-income household. Those exist and they're very real. The other half of that equation, though, is that I have to be upside down on my mortgage and I have to be able to not sell my house. And that part of the equation is as untrue as it has ever been. We have record levels of equity. And even if you didn't pay your mortgage this year because you couldn't and you're in the forbearance program, you likely gained a lot of equity on your house. You gained a lot of wealth while not paying that mortgage. So at the time that you have to do your loan modification, if it turns out that you are never going to be able to afford your mortgage again, your resolution is to sell your house and take your equity gains, take your cash. It's not to go into foreclosure. So lots of loan modifications to come this year. And those are going to result in some very interesting things like challenges. There's going to be backlog. Like there's a lot of risk in the system there. On the other hand, very few people are going to need to use the foreclosure as a way to get out of their cycle. Remember the last cycle in 2008, these were people who were upside down on their mortgage when they bought the house. They had 0% down. They immediately couldn't make their mortgage payments. That's what we were facing in 2008, 2009. And it is not at all the case right now. Commercial multifamily delinquencies and foreclosures are at risk, right? If there are rents, people not paying rents, that's definitely going to be a risk for the commercial properties, multifamily properties, but not in the single family space really at all. The market could decline if, for example, the government fails to do a new stimulus, and now we have pandemic challenges that increase, and we get further into recession. And if the stimulus doesn't bail out the people who are impacted, the businesses that are impacted, that could deepen a recession, that could very easily back off the demand. And that would be a risk to the market. Like our prices could back off like they did in 2018. And they did in 2018 because of rising rates. So rates go from ultra low to moderately low, and we're going to be sensitive to it. So rate spike is also a risk for home prices in 2021. Those are the risk factors. They are real. As of right now, there are no signals of them in the market. So if you've got people worried, maybe you are one of those people that had a conversation with folks about what might happen in 2021, and they're thinking maybe I need to sell. Early in 2021, January, February, March, looks like good opportunity. All the pieces are in place if they are worried. Okay, let's switch as fast as we can. I've gone through a ton of data here. I'm going to switch to share the browser here, and we're going to start with some local data. And all right. I'm looking at, I got a bunch of reports open. It's already 10:45. I've been talking a lot. Let's look at how the regional and local markets are playing out. We're looking at California. This is the market action index that I mentioned. Strong sellers market in California as a whole. We can see the implications on pricing that happened during the year. Here's an interesting way, I talked about price decreases. So in California, we're only at 23%, which is lower than the national average, right? We know that demand is higher. Price increases are fewer, and that tends to be because in a lot of the big California markets, it's harder to do some of the flip and the iBuyer actions, the higher price markets, than it is in places like Texas or Atlanta. And I'll show you how that plays in. If we look at LA, much stronger, for example, than the Bay Area this year. You can see our year over year price increases. We can look at the market segments. Now, remember, I mentioned to look and say, use the market segments to see where the demand is. So in the LA region, in the under 700,000, 59 days, the expensive stuff is now almost 6 months, 5-6 months. So that's an important distinction in LA. If we switch to San Francisco, you can see in San Francisco price increases. This is the San Francisco, this is San Jose. So South Bay, even stronger than in seller's market. The price increases have been nonstop this year. In the South Bay, Silicon Valley market, you can see the high-end stuff moves even faster than in LA, right? So just super tight inventory, super strong demand. If we switch to San Francisco, this is the whole San Francisco, North Bay, East Bay market. You can see we're still strong sellers market, but in the 40s, significantly cooler than, for example, San Jose. We can see the inventory climb. We're down on a lower inventory, more volatility around the beginning of the pandemic, but also a tighter price range, so it doesn't have some of the ultra high end, has lower and has a lower entry point than does, for example, San Jose. And because it's already pretty late, I'm going to zip through a lot of these. In San Francisco proper, we have a lot of questions about the San Francisco condo market. You'll see that there's condos all over the city, and it's actually pretty diverse. But you can see where the prices got hit in San Francisco this year. Here are the condos from like $1.4 million down to $1.2 million price range in San Francisco. So that is where demand fell way off and where the pricing fell off. It started the year super strong, but then here it is starting first, pandemic kicks in March, and we see the impact right away. And really, if you dive into the downtown, south of market areas, that's where you can see the biggest impact. It's in buyer's market territory. The inventory actually had climbed way up and has been pulling back a little bit this fall. But really, you can see that in these are the high-rise condos downtown, the most expensive stuff, the days on market is climbing. That's really where you can see the buyer's market. It's really fascinating because it's that condos in a town where everybody can work remote, in the face of all the other things being a good time to buy. Let's look at Dallas real quick. One of the things about Dallas is our price increase number is all the way up at 10%. Remember, the national average is 5%. The California markets are at 1% to 2% price increases. And so in Dallas, that's because it's easier to buy, it's easier to do a lot of the investment properties, and the iBuyers are much more active. So you'll see that these price increases, that's super bullish for prices in the future. You can see Dallas had a big year, year-over-year gains and we can look at the market segments, the 900K, and anything under 500K moves in just a couple of months. So you can see exactly what you're going. And this is all the Dallas-Fort Worth area. I've got Florida open. Florida is a little cooler, but Florida also has a lot of that investor activity. So price increases at 8%. Florida as a whole. We can look at, interesting in Florida, you can see exactly where the demand is. So there's obviously, some high priced properties in Florida, and they sit around for a lot longer. The lower price stuff can move much more quickly. So when you're working with your clients, it's pointing them to their price range is exactly how we set the expectations. In Chicago here, for example, has only 2% price increase. That is a significantly less bullish signal, although because we are in, this millennial mode, we're in the low price mode, we're still in the seller's market. Like there's still a ton of demand out there, and prices in the Chicago area showed it for the year. The market as a whole moves slower in Chicago. So down here, the fastest stuff is still 100 days in Chicago. That's also partly seasonal. Boston has had a bigger year than, for example, Chicago. The economy is stronger. And you can see that in the lower price stuff moves much more quickly in Boston, though still not really that investor flip market. So still, a 2% in Boston. I'm just gonna blow through these as quick as I can. We have Atlanta open. Atlanta is, an iBuyer market, so you see 9% price increases. Very smooth growth year on price, and you can see how inventory is way lower in Atlanta than it normally is. 21,000 properties were down less than half of where we were last year at this time in Atlanta. And this is, again, the whole Atlanta metro area. The price decreases at 25%. So that, again, is bullish. If you think normally it's 35%. These are really, that bodes super strongly for the first quarter for Atlanta. Now let's jump into some of the Zoom towns. Boise, Idaho, lots of inbound immigration, lots of people from, for example, California can move and buy affordably. The market action index at 80 for Boise. You can see what that's done to pricing for the year, up 25%, 30% for the year. And you can see in Boise exactly where the demand is. So anything under 750 is moving fast. The expensive stuff in Boise, that's pretty expensive for Boise, takes much longer to move. Bend, Oregon. So Bend, Oregon has got a lot gets a Seattle and it gets a San Francisco and LA crowd. Bend, Oregon has been off the charts this year. Not quite as hot as Boise on the market action index, but pricing like through the roof for the year. And the cheap stuff in Bend, 50 days. I grabbed a couple of New York area markets. So, suburban Connecticut moving out of New York City. We have inventory has just plummeted during the year. Pricing has climbed. We can look at inventory, look how much lower the active inventory is than normal, 200 normal to 75. Like way less than half normal inventory in suburban Connecticut. I've got Rhinebeck, New York, which is Hudson Valley. A lot of Zoomtown move into Hudson Valley. So price appreciation. These are, because these are more remote and tend to be more like second home markets, that generally take a lot longer to sell. But let's see over time if that's improved. We can see it's lower than last year at this time, but they're actually, you can see it's in a general time to sell range. Very much closer to a balanced seller's market, even though the pricing has kicked in this year. I'm going to zip to Truckee, my favorite market, because I have a house in Truckee. And Truckee is where all of San Francisco moved this summer. You can see price increases at 6%, so higher than, for example, San Francisco proper, but inventory is so low. Inventory here, 175 through 770. So, a third of where, not quite a third, like, 50, 60% lower than normal. Like you can see exactly where people are moving. And we can also see how we're set up for 2021. All right, I'm going to head back to my slides, and we will finish up. Okay. Let's see if I can. Oops, my little screen share stopped working. One sec. Oops. My slides are stuck. I'm going to do one more thing here and give it a whirl. My all right, I'm just going to switch back into no screen share mode and talk it out. There are big themes that we saw for the year, and our big, there we go, our big themes really that we want to remember to use the active market data. If we're relying on the traditional data, these are the prices of the homes that sold last month, or these are the headlines, it's going to be way behind. And the market is moving super rapidly. There are a couple of catalyst points that we want to keep our eye on. So keep using the active market data. We know that the inventory is going to start the year super low, and because it starts super low, it's going to be, no matter what happens to the foreclosures, to interest rates, all those things, we're going to be in a tight market. One of the things that we have to remember to do is, for example, use the market data as opposed to a listing alert for reaching our clients. And then, of course, finally, the risks that we want to keep our eye on for the year are going to be rising rates, because that will bring back demand, pull back demand. If stimulus fails and we go into broader recession, the risk for pricing. In general, we don't see risk of foreclosure, but we may have opportunity for a handful of those folks who need to sell their property and take their equity cash to happen. That's likely not going to have to happen until July, but you might want to keep that on your in your client communication this spring. As of right now, the January 31st, but that's probably going to be pushed back all the way to June. So keep that in mind. It's 11 o'clock. I'm going to wrap up right now. Thank you all for your time. Stop by Altos Research to book a demo, grab that ebook, subscribe to the YouTube channel to get the videos each week and be notified here. And I look forward to much more next week. It's going to have a wonderful holiday, and we'll do another webinar in January to look at the start of the year. Thank you all.